QuickBooks Pro Desktop 2021. Enter transaction purchasing investments using bank feeds. Let's get into it with Intuit. QuickBooks Pro Desktop 2021. Here we are in our bank feeds test file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. In prior presentations, we've uploaded information from my banking system into QuickBooks so that we can practice the bank feeds. This time we're going to take a look at a transaction where money is going out and we're purchasing investments such as stocks and bonds, mutual funds, or something like that. How to record that with the use of the bank feed transaction. Let's open up our reports first to think about how this would be done. Reports drop down, company and financial. Let's first open up the balance sheet report. Now I'm going to change the dates up top in the customize field from 01/01/20 to 12/31/20 and OK. Here we have the balance sheet. Let's open up the P&L, the profit and loss. Reports drop down, company and financial, P&L, profit and loss. This is going to be from 01/01/20, 12/31/20, and OK. So if we go back up to the balance sheet then, the transaction we're taking a look at is the cash would be going out of the checking account. We have negative cash now because we haven't recorded the deposits or the beginning balance. But we're saying cash is decreasing from the checking account, which we will see in the bank feeds. The other side is going to be an investment, not an expense. It's going to have to be up here in the other investment area or the other asset area. Now, this is going to be something that if you're a small business, then notice that you're probably not going to have a lot of money that's going to be into an investment unless it's in something like a 401k plan, although you might take some money out for a temporary holding into something like investments like stocks and bonds and mutual funds. However, you might use this system for your personal bookkeeping as well, and either use classes to break out personal bookkeeping possibly, or have a second file, which is great for the desktop version that you can do so to track out your personal expenses as well, and you can use the bank feeds there too. So to do that, then you might have a situation where you have investments in mutual funds and whatnot that you want to track in the QuickBooks system. So what I would recommend in general is to track your system in QuickBooks to just have the overall items in there. In other words, if you invest in something like with your bank, possibly at like a Chase Bank, and you have mutual funds there or something like that, and you invest possibly with something like an E-Trade or an online trading where you can have stocks and bonds and mutual funds and whatnot, then you might want to just put the total amount in your QuickBooks system. For example, you just might want to say, this is my investments in stocks and bonds related to E-Trade. This is my investments in something related to Chase, my bank. And then you can take your bank statements periodically that will give you your investments in stocks and bonds and adjust the totals to them and simply adjust them as they change for market value, meaning increases or decreases in the market value, instead of adjusting each line item. QuickBooks software is not designed to track the daily changes in the system. They're there to give you it's here to give you a periodic look at where you stand in total. So you probably don't want to break out too many categorizations. That said, however, you might want a little bit more detail. You could put into the balance sheet some individual mutual funds. You might break it out between like small cap and large cap investment, or between bonds versus mutual funds and stocks, equity versus whatever. You might break out large categories. Bottom line is, however, I wouldn't break out every individual investment, every stock investment in here, or even every mutual fund. I would break it out at least by groups of mutual funds and maybe by institution. And then you'll put the overall number here, put the overall changes from that number that will happen over time, meaning gains or losses that take place, which you can see periodically from the bank information or the investment company information. And then you'll record the gains and losses on the income statement as you record those periodic type of adjustments. So that's going to be like the idea of it. So that means when we put money into the account, then into the investment account, we're going to have to set up another asset type of account. I'm going to call it E-Trade. I'm going to assume we're just investing in E-Trade. We'll put the investment in just a debit into E-Trade, and then we'll track the detail of that investment in detail from the reports that we'll get from E-Trade, we're going to say, which will be on mutual funds, stocks, and bonds, we would assume. So I'm going to go back to the home page And then we're going to go into the banking dropdown, and I'm going to go to bank feeds. I'm going to go to the bank feed center, and we will open this up. I'm going to move over to the unrecognized items, and then I'm going to check my cog over here. I like to have everything checked off on the cog, close that off. We're going to filter then. I'm going to filter this out, and I'll filter, this time I'll just try to filter by check. And I'm going to say, okay, let's do that. And then I'm going to use these same Primerica items that we used basically for inventory before. And now I'm going to assume that they're purchases of mutual funds, right? So I'm going to say these items are going to be purchases of mutual funds. So I'll take these two then, and then we're going to be setting them up as if they're mutual funds. So I'm going to then say, all right, the check date, the payee. I'm going to set up another payee. Now, I already have Primerica and Primerica Life, so I'm going to set this one up a little bit different. I'm going to say Primerica like 01 or maybe ACH. So I'm going to say, all right, let's say a new one, and I'm going to call it a vendor, even though you might call it other in this case because you're not really buying something from it. It's more like a bank, an investment company. So I'm going to say Primerica, and then let's call this one or ACH. Let's do that. Primerica ACH, and I'm going to say copy, vendor, and that's it. I'm going to say okay. And then the account that I want to go to, I'm going to set up another account, and I'm going to call this an investment account. So we could say, I'm going to say this is an investment, so it's going to be an other current assets type of account rather than an expense. And I'll say that we're buying this from Primerica. Primerica, and that's going to be in my investment company. Now, maybe I have multiple investment companies. If I only have one, I might just call it Primerica, like investment Primerica. If I have two, then maybe I want to make this a subcategory of another account. Maybe I want to say, I want to make this a subcategory of another account, which I'll set up. And I'm going to set this one up as an other current asset, which is going to be called investments. So this is going to be the parent category, investments. Then we'll have the subcategory, Primerica, within it. So I'm going to say, let's save that. Let's take a look at what that looks like in our list drop-down, chart of accounts. And so now I set up investments, and I got the subcategory of Primerica that falls in under it. So I'm going to say, okay, and then if I start to have another investment in E-Trade or my bank or Chase or something like that, then I can list those by institution under the parent of investments. So I'm going to say, okay, that looks good. And then I can add details if I so choose, add more details. I might want to put something in the memo of the type of investment in, mutual funds. I could put something like that in the memo and possibly copy and paste it into the... So there we have it, and so we have that set up. I'm going to say save, and let's record that. And so now if I go to the balance sheet then, I'm going to say update the balance sheet. It's going to be decreasing the checking account, and the other side's going here to this investment. So if I go into that investment, there is our transaction there. So then let's go back into the bank feeds and just do the last one the same way. I'm going to say this is going to go into the Primerica here. And I'm going to say this is going to be the account of the investment in Primerica. And then I can just save that one. I'm just simply going to add it here. You could change the memo again, but I'm just going to add it here and say yes. And then if I go back up to the balance sheet, we're going to go back up to the balance sheet. And then we have the $80 down here in the Primerica item. Now then, obviously, we have to enter the beginning balance. We only enter the detail. If we had investments prior to when we started the bank feeds, we would have to enter the beginning balance. So let's just kind of imagine that situation. You'd say, okay, if there was a beginning balance in the bank feeds, this would be similar with all your other beginning balances. You'd have to enter the beginning balance there. You could do that with basically a register. So I could go to the lists drop-down chart of accounts. And I could say, okay, let's go into the investments for Primerica. I'm going to double click on it. I'm going to put the beginning balance in there. Basically, I'm going to add it as of before the year that we're currently in. So I'm going to add it as of 01/01/19 just to double check that I don't kind of mess anything out. And I'm going to say that the beginning balance, let's say the prior statement let's say 5,000. And so then we increased it with another investment of these two items. So then the other side of this account, this is going to be an increase to the Primerica account. The other side, we want to kind of wash out into the equity accounts. So because if it was an income statement account, it would roll out into equity. Now note again, if we're doing this in the middle of the year, we got to be kind of careful on what's going on. You would like to start any new bookkeeping. If you're continuing bookkeeping, you want to start it in January if possible. If you're starting from scratch, basically, then you kind of want, then you'd be okay whenever you start because it'll be zero balances from the beginning. If you're continuing the bookkeeping process, you'd like to start it in January. Otherwise, you got to transfer over like the income statement temporary accounts during the year. But in any case, I'm going to put it into the equity account here. So equity account, and I'm going to call this the beginning balance. And so I'm going to say, okay. So that, and now if I go back to the balance sheet, then now my Primerica, I'm going to imagine, matches at least the beginning balance for the statement that we have from Primerica. And now the other side went to equity here, and it went into equity, and it did so with a journal entry type of format. If I go to 010119, there's the journal entry, or actually they did it with a deposit type of form because it's going into an investment account. So so that's going to be our adjustment that we have. If I close this back out, then so from that point, a couple things could happen going forward. You could have dividends or interest from this investment. If you take the dividends or interest out, then they will hit your bank account at some point, and you'll be able to record the dividends and interest when they hit the bank account using the bank feeds. If you reinvest the dividends and interest, then you can record the dividend and interest increase in the total Primerica balance, the investment that's going to go up. And you could have increases in terms of basically the value of the stock, just increasing in the price of the stock. So let's say it increased in value, because that's usually the more confusing one. If it went up to 6,000, you look at the next statement for Primerica, it went up to 6,000. I want to increase this to 6,000 possibly to keep in line with the current value of it. And then you got to decide, do you want the other side going to the income statement? Because you haven't realized it, you haven't sold it yet. So you could put the other side basically to the profit and loss statement, or you might put it to unrealized gains and losses on the balance sheet. I'll oftentimes put it, I mean, it depends on what you want to do, but if you put it on the income statement, then you might want to put it on the bottom of the income statement as other activity, not part of your normal, transaction activity in the other section. So that's what I'll do here. I want to go to the profit and loss items, and I want to imagine an increase in revenue, but not up top because it's not part of my normal business and I haven't realized it. I'm going to put it into other income down below. So to do that, let's just imagine it went up. You got to kind of do it with a journal entry or a register again. So you'd go back into the register and say, okay, now it went up to 6,000. Let's imagine at the end of the month. So let's say it's at, let's say we're at changing the date here to 07/31/20. We're going to change it for the statement, and I'm going to say it increased. And we'll pull out the trusty calculator and we take whatever numbers on the statement, which I'm going to say is 6,000 for the fair market value minus the 5080 difference, 920 increase. So we're going to have then an increase of the 920. And then the other side needs to go to some kind, I'm going to say an income type of account. So I'm going to set up a new account here. I'm going to say I need a new account. And I'm going to make it an income, but not just like a normal income account. I want it to be in other income down below, other income. And so I'm going to call it unrealized gain or loss. So that means whether I have a gain or loss, I'm going to put it here and it'll kind of net itself out. Or you can put unrealized gains and unrealized, you got to net them out normally. I think that'd be the easiest way to do it. And then I'm going to say save and close. And then I could put in the memo, this is my adjustment, period end adjustment. I won't do it here, but I'll say record it. That brings the balance up to 6,000, which we're imagining now matches the balance on the statement. Closing this back out, saying, okay, on the income statement, now we have this gain that happened. It's like, well, the stocks went up by the 920. It's unrealized. We haven't sold them yet. They could go down tomorrow, But I'm going to record that down here on the income statement anyways to show the activity of the gain or loss on the income statement as opposed to another section on the balance sheet in equity, which I think that kind of confuses people more, but it doesn't mess up my bottom line on the income statement prior to that, because I already have my balance here of my normal activities, right? This is my normal activity. This is the activity that's kind of weird, the activity we haven't yet realized due to the investments going up or down, if that were the case. And then on the balance sheet, we now made the adjustment here. So we have the adjustment to the $6,000 for Primerica, which should match the statement at the end of the month. And if I go into it, we see the adjustment, and they used a deposit form again to make that adjustment. They used the deposit form, which is a little bit weird because I put it in there as an other current asset type of account. I thought they would default to a journal entry, but that's fine. It's in the investment account, other current asset type of account, and we increased it there. So that's how you can kind of take care of the investments, and then track if you're doing tradings and trading a lot and whatnot, and you want to track the day-to-day activity, you want to use some other software that's designed specifically for that.